Imagine earning extra income from stocks you already own without selling them. That's the core promise of covered call strategies. Covered calls are a smart way to boost portfolio returns while limiting risk. But how exactly does it work? And what should investors keep in mind before diving in? At its heart, a covered call means owning a stock and selling a call option on that same stock. The option gives someone else the right to buy your shares at a set price within a certain time. In exchange, you collect a premium upfront, money straight into your account. It's like renting out the potential for big gains while keeping your stock and pocketing rent. But what's the catch? If the stock price rises above the strike price, you may have to sell your shares at that fixed level, missing out on extra upside. On the other hand, if the price stays flat or dips slightly, you keep the shares and get to repeat the process, generating steady income. The key to successful covered call writing is knowing your goals. It's ideal for investors who are neutral to mildly bullish and want to earn cash from stocks that aren't likely to spike soon. It's not a strategy for runaway rallies or for stocks you never want to sell. Ultimately, covered calls simplify the balancing act of income and growth. They may limit huge wins, but they help manage risk in uncertain markets. Like a landlord who rents knowing there's a chance the property might be sold, you're rewarded for calculated risks. And that's what makes covered calls a time-tested tactic for active investors.
Okay, so in this video, we'll be covering on what are cover calls and what we need to do, which are very popular these days. So covered calls are basically an income generation strategy with stocks that you already know, and uh, and this is how you will produce the. So suppose what's a covered call? For example, you have the 100 shares of Apple or whatever the stocks that you hold. You sell a call option. That means that you are willing to sell those shares, which is 100 shares, and they are usually referred as one contract for a predetermined set price, which is called the strike price. But when you sell them, you collect a premium, and that's your income. You tend to keep it. You, no matter what happens to the stock, but this premium will be yours unless you exchange the position or roll out the position or roll in the position, which we'll talk about later. But obligation to sell. So one of the things is that you have an obligation to sell at the strike price. If the stock moves to that price or beyond, you would have to sell the stock. So why covered calls? Because most of the time people have the stocks. They just wanted to create some regular income, and this is one of the ways to create a regular income out of a stock they already own. Sometimes it is also low volatility context where they are likely to make the income and their stocks will not be called out. It often remains somehow more realistic in the case where the market remains neutral to bullish. Why bullish? Because the stock has a value and hence somebody would be willing to pay the premium. So that's one of the ideas in here. Now, next, take a look at uh, the idea in here that uh, the the best market conditions are the sideways market, meaning that the stock is not on rise, and hence it will not hit the strike price, and hence it also have to have something called the moderate implied volatility, and the stock should be liquid. Liquid meaning that there is lots of buyer and seller for this particular stock. The trade-off, what can be the payoff structure? The maximum profit is capped that if you in the case of premium, you may receive a fixed premium, and also if the stock is called off, you will get a fixed profit, right? That's a, otherwise you could get the price of the stock whenever you want to sell, and this price could be higher than the call price. As we talked about, that the risk is that your stock will be called off. Generally, the idea is that the the good conditions for the selling the covered calls is using a delta, which we will talk about. It's a parameter which actually determines that how the option price is connected with the asset price, such as the option of Apple, how the option of Apple is connected with the price of the Apple stock itself. And this is what it tells us in here. Similarly, the other parameter is called the DT, which is called the date to expire. And usually people may send something called a weekly, 7 days expiration, or 14 days expiration, bi-weekly, or a monthly, which is 30 days, or beyond a month, which is 45 days. And the other thing is that the premium is really dependent on the IV rank of the or implied volatility of the stock, meaning that stock moves a lot in the price, then the premiums are likely to be high because somebody is taking risk to commit to the option to buy that stock. Now, the two possibilities, as we discussed, that the date to expire is weekly or versus monthly. So in this case, weekly, there are 52 weeks in a year, and hence the income could be higher, but then requires a management. In a case of monthly, there is a less management, but of course, there is a compromise in terms of the income. So a very simple trade in here that you suppose an SPY is selling at a regular market price of $450. You decided to or sell a call option where you committed to sell a, a 100 shares of SPY at $455. So you will, if it is called off, you could be able to sell at $450. But then if you commit to sell at $450, you will upfront get the $200 premium, which is called the option premium that you would look into. Now, in case you are assigned, since you already have the stock, you don't lose it. But what happens that you will realize the profit, and it will be a possibility of an event where you could have some capital gains tax incur as well, depending on your long-term, short-term holding. You can always re-enter the market, and that's called the wheel strategy. We'll talk about this. And hence, the other possibility is that if you don't want an assignment, you can buy back the call option and sell it later at a higher price. So this is also a possibility. What are the risks involved in here? For example, the if depending on the previous example where the SPY is selling at $400 and you committed to sell at 450, suppose during that time the SPY hits $460, then you will be losing $5 because you have locked already your price that you want to sell. And there is a downside risk also that if the stocks get stanked, you could be also having to have difficulties in terms of selling it. Earning volatilities are there, which is a stock can be having to have some earning periods, which can really impact the price. Best practices to avoid earnings period, which is when suppose in the case of Apple there is a earning calls or weekly quarter, or I would say in a quarter there is a board meeting which is about the earning calls or the investors meeting. So these are the meetings period where you should avoid to sell the calls. Why? Because the prices could spike on crunch either way, depending on the outcome of the meeting. And similarly, you should not wait until day to expire, but rather roll out or roll a, uh, in terms of uh, the at the 70% profit mark in general. Sometimes 50 plus market also can work out. So the next issue would be to look into a comparison between the cover calls, wheels, and the postman's cover call as well. So that's the pretty much discussion. Uh, who should use it? The first of all, the income investor who are looking to invest, retirees who already have the stock and they would like to get some income out of those stocks. Long-term holders also they can trade these stocks in terms of finding cash out of their stocks, which can be only received if they sell the stock. So they don't have to sell it; they can simply sell the covered calls. So summary is that the turn stock into income, and but you still for any trading you need some uh, discipline.